Good morning to everybody. Good morning, Nilesh. Welcome to this Creative Zone webinar. This one talks about economic substance regulations introduced in the UAE lately. Nilesh, thank you so much for taking the time to go through this webinar with us. Thank you.
Thank you, Lorenzo, and it's my pleasure and privilege to do this session, this webinar, along with Creative Zone. Thank you for the invitation, and I look forward to an interactive session.
Thank you so much. So, for all the attendees out there, Nilesh Ashar is a tax partner with KPMG, here based in Dubai. He has over 24 years of experience working with the Big Four international advisory firms in M&A and tax-related issues. He advises clients all over the Middle East, India, and more mature economies in the UK and Europe. So for all the attendees out there, we would like to hear your thoughts, hear your comments, engage with you. So feel free in the Q&A section to put across your questions for Nilesh. So that as we go through the session of today, we can also pull out some of the more interesting questions. So Nilesh, let's get right to it. Tell us about the economic substance regulation. When was it introduced, and what are the main pillars behind this regulation?
Sure, Lorenzo, and I might just point to a slide or two as I go along. So I'm just going to try and keep my screen, share my screen, and we can talk through. Can you see the?
Yeah.
Yeah. Maybe we can talk through this. So I think if I look at economic substance regulations and compare it, go back to 2017, when we were in the rush of introduction of VAT, there was a lot of awareness that businesses awareness session that businesses were running. The FTA was running around introduction of VAT, and there was a clear revenue generation measure that the government was looking at. In contrast, the economic substance regulations have just been introduced without any detailed awareness or dissemination of information on the regulations to the public. Of course, for the tax practitioners like ourselves, we were aware this is coming. The economic substance regulations is largely on the back of the OECD's initiatives on global tax avoidance measures that multinational companies have been alleged to engage or indulge in. As part, UAE as a member of the OECD's inclusive framework on BEPS is committed to participate in any global tax avoidance program or any coordinated attempts at tax avoidance that multinationals may perceptually engage into, and has committed to introduce the economic substance regulations following one of the key actions of BEPS. And really what this requires is that there are about 10 or 11 jurisdictions, including the UAE, the others being Bahrain, Jersey, Guernsey, BVI, Cayman Islands, that are referred to as the noon jurisdictions, which have no or only nominal level of corporate taxation. And these jurisdictions have committed to introduce economic substance regulations because, and UAE was part of the EU's blacklist, as you're aware, because it does not have any level of corporate taxation or any level of substance regulation. So UAE, along with these countries, committed to implement the economic substance regulations, which effectively requires businesses that all UAE businesses that carry out certain types of activities, and we'll come on to those activities in a bit more detail. But every UAE business or UAE entity, which includes branches of foreign companies, joint ventures, etc., that carries on one of the 9 relevant activities is required to demonstrate, actively required to demonstrate certain level of substance.
Okay.
The regulation was introduced in on April 30th, 2019, under Cabinet Resolution number 31 of 2019. There was a lot of further guidance and decisions that have been issued, where the regulatory authorities have been announced. So most free zone authorities for entities that are set up in the free zone are the free zone authorities are the regulatory authorities for the free zone companies. For mainland companies, it's the Ministry of Economy. There was further guidance issued in September. There was a list of FAQs that came out earlier this year in January, and a further clarification in terms of more description on the meaning of the relevant activities, the 9 relevant activities that I was talking about. There's further guidance that's come out in the relevant activities guide. So as you can see, a number of legislation and guidance has been issued by the Ministry of Finance on this. And gradually, as we've gone along this, businesses have started realizing that the economic substance regulations are here to stay. They will be implemented and they will be enforced by the authorities. And just to complete this slide, there are 2 key deadlines that businesses should be wary of. One is the notification that most businesses will need to make between May and June, depending on where they are set up. These are notification to the authorities confirming whether or not a business carries on one of the 9 relevant activities. And to the extent that they do carry on a relevant activity and earn income from that relevant activity, there is a return to be filed or a report to be filed by the end of the year for the financial year 2019.
Right. So just to get this right for our clients out there, we have about 160 people connected. A lot of our clients come from free zones, from mainland, from Dubai, DED, Economic Department. In the case of the free zones, to summarize it, you're saying the free zone authority is the regulatory authority, and this has to be communicated with the free zone, right? When it comes to the submission of these reports and tests, correct?
That's right. That's right. So every free zone is a regulatory authority for the licenses that are issued by those free zones, and the notifications and the reports currently have to be filed with the same free zone authority.
Excellent.
And most free zone authorities have come out with guidance and due dates for filing of these notifications.
Right. So for the clients to be aware of those due dates and the compliance, they have to communicate with the authority. Us as a company, I'm guessing as Creative Zone, we have a department and a separate arm called Tax and Accounting, where we can also inform our clients of what are those due dates and what kind of information is to be shared with the authorities. Now, in the case of Dubai mainland companies and Abu Dhabi, who is the regulatory entity?
So for mainland companies, both in UAE, both in Dubai and Abu Dhabi, the relevant regulatory authority is the Ministry of Economy. They are the ones, if you can see the slide that I presented, they are the ones, one of the key authorities that are yet to announce a notification date and a notification format and a notification guide. I think we, along with most businesses, are eagerly awaiting that. And unless the current situation delays matters, I think the expectation, and one can't be certain on this, the expectation is that Ministry of Economy will also announce a notification deadline of on or around the 30th of June 2020 for the 2019 financial year. So
does this mean that company owners and companies need to submit the reports before this due date?
It's before or by the due date. And for authorities, so if you can see, a number of free zone authorities have come out with extensive user guides, and some of these have to be filed online. The notification form has been prescribed. It can be filed before the date, assuming businesses are ready, and the authorities' portals are ready. But you don't have to file it on 30th of June. It can be filed before 30th of June. But I think the important bit before the filing, because this is now a filing that's going to a regulator, it's important that businesses internally assess which entities are going to be in scope and what is it that they're going to file. Are they going to file that they carry out a relevant activity and will therefore be filing a more detailed report at the end of the year?
Yeah.
Or they have not carried on a relevant, or they've carried on a relevant activity but have not earned any income from that activity? Because the key for the reporting requirement is that there must be a relevant activity and there must be income that arises from the relevant activity. So if you've carried on an activity but not earned any income, there may only be a notification requirement, but not the requirement to report. So there's some analysis that businesses need to do prior to filing that notification, so that they are making an accurate notification.
Right.
And
so
I think
before going into the actions that that involve the reporting and what this entails, let's go into the activities. What are these 9 activities that you were mentioning that are relevant to this new resolution?
Yeah, so I've got them in a box here, and hopefully you can see the 9 activities that are discussed, and we'll talk through some of the more common ones in more detail, Lorenzo. Yeah. But the 9 activities are banking business, insurance, investment fund management business, lease finance business, headquarter businesses, shipping business, holding company activities, IP businesses, and distribution and service centers. Now, each one of these relevant activities, so one might ask, why these 9 activities? Each one of these activities, according to the OECD standard and OECD's analysis, they refer to the income that may arise from these activities as geographically mobile income. What that really means is that these activities have the potential of being performed in any jurisdiction without there being a need to actively demonstrate substance or actively have substance in those jurisdictions. And the idea is exactly to ensure that these 9 activities, which have the potential for being performed and income to be earned without there being appropriate substance, for these 9 activities and companies that perform any of these 9 activities to demonstrate that they have substance in the UAE and they meet the substance test, which we'll talk about in a minute. And therefore, these are the 9 activities that are covered. It's interesting to note that there is no sector-specific exemption for these activities. So there's not that there is an exemption for the oil and gas sector or the financial services sector in general. I think every business and every entity that a group may have in the UAE needs to look at these tests on an entity-by-entity basis.
Right. Now, how do we go about these tests? How do we prove substance in any of these activities? For our viewers out there, the attendees, they must be asking themselves, well, what is it that I need to show? What does it mean that I need to show substance in these activities?
So I can talk about what the tests are. Unless, Lorenzo, you wanted me to cover any one of the key businesses and explain them in more detail, I'm happy to do that, or we can look at the tests as well.
Yeah, let's go into the tests, and maybe we can go a little bit deeper into the different activities and kind of divide them, because I think you said something very important. We have a lot of clients that perhaps they're in the professional services industry, media companies, and so on. So perhaps this does not relate to those type of activities, correct?
Well, this is where I wanted to touch upon some services. So, whether it's a media company, professional services companies, other engineering, IT services companies, they could potentially fall in scope. And which is why I did want to talk about some of those relevant activities. But we can maybe we can come on to that. Maybe we can come on to that.
And how it would relate with the different type of activities and the most common ones, general trading companies. Give us a look into this,
Sure. So let me very quickly cover the tests, and then we can go back to a more detailed discussion on some of these activities. So there are 3 broad tests that every business that carries on a relevant activity needs to satisfy. The first test is to demonstrate that the entity is managed and directed in the UAE. So the company needs to show that it has an active board, that is present in the UAE when the meetings are taking place. The quorum of the board is present in the UAE when the meetings are taking place. The board directors have the necessary skill sets and the qualifications and the CVs to perform and execute their duties. The minutes are signed, the minutes are recorded, the minutes are maintained in the UAE. So the first part of the test is all around ensuring that the board and the management of the entity takes place in the UAE, and there are some detailed tests as to how you would meet those. The second test is to demonstrate, and there's an active definition of core income generating activity. But the idea is to demonstrate that the core income generating activity in relation to the relevant activity takes place in the UAE. So for example, let me just, so if you have, so for example, if a company is performing a banking business in the UAE, or maybe let's pick up on headquarters or distribution and service center businesses. If you have a headquarter business on the top right here, the company needs to demonstrate that there are appropriate management decisions taking place here, that the company is incurring operating expenditure in the UAE on behalf of the group, it's coordinating group activities and functions. If you're in a banking or an insurance or a lease finance business, you can demonstrate that the activity, for example, lease finance business, the activity of lending, agreeing lending terms, identifying the assets to be leased, setting the terms and duration of the financing, all of those activities are taking place in the UAE. So the core income generating activity in relation to the relevant activity must take place in the UAE, and that's the second test that you need to demonstrate. And the third test is on the quote unquote the adequacy of the adequacy test. And this really requires businesses to prove that they have adequate qualified employees, adequate operating expenditure, and adequate physical presence of physical assets in the UAE necessary to carry out your function. Now, the obvious question that might come up is what is meant by adequate? Because what may be adequate for your business may not be adequate for my business. What may be adequate in year one for the scale of business may not be adequate in year two, and so on and so forth. So adequacy is not defined. I think the onus is on the company to assess the adequacy and be able to prove and self-declare the adequacy test, and then prove in the event of a challenge from the authorities that they have adequate employees, expenditure, operating expenditure, and physical presence in the UAE.
Right. Well, you touched upon a few important topics there. You were talking about, is the entity being directed and managed from the UAE? You were talking about the need of having there a board. How does it work with sole owned companies when there is just a sole owner, there isn't the board?
Yeah, so there is, it's a good question and very relevant for perhaps the audience on this webinar. While there are, I've set out what the tests are to determine whether the direction and management takes place in the UAE. There is guidance in the ministerial decision and the FAQs that where a company does not have a board, but is a single manager company, a single director company, or a single employee company, then all of these requirements that I've put up on the slide need to be met by that individual. So what that really means is that obviously an individual cannot have a meeting with himself, but the requirement for that individual to be based in the UAE when certain decisions for the running of the business is taken, those decisions, if there are any discussions or consultations with other committee or other employees, those are documented, deliberated and documented in a board resolution or a meeting resolution, which follows the criteria that I have set out of requirement to meet in the state, requirement for the meeting discussions to be recorded, whether those are committee meetings or whether those are meetings with colleagues that resulted in a decision being taken. All of those should then be collated documented in one file. And the deliberations should be documented, and it should be signed by the single manager and the owner. So the requirements do apply. Of course, you don't need to have a quorum of a board because there's only a single member or a single manager company. But the requirement for that manager to be appropriately qualified, for him or her to be in the UAE when the decisions are being taken, and the discussion around the decision, the deliberation should all be recorded and documented and signed by that individual.
Excellent. We have quite a few good questions coming in. I'm going to slowly start chipping those in throughout the conversation. So we might be jumping around some subjects. To the attendees out there, we have 170 people connected. Please keep on bringing your questions. We're going to start bringing them out. There was another question that I just saw that was kind of interesting. You were talking about the second element being to prove that the core income is derived from the UAE. What percentages are we talking? What are the thresholds? And how do we go about presenting this to the authorities?
I think that's a very, very good question, Lorenzo. The short answer to this is that there is no threshold. There is no threshold, unfortunately, and therefore, even a dollar or a dirham of income that you generate from a relevant activity, you need to be able to, you will need to notify and make the report and meet the tests in relation to the income that's generated from the activity. The only threshold or exemption, so there are two broad exemptions or thresholds. One, which may not be relevant to this group, or for completeness, I'll mention it, that if you are an entity that's owned by the federal or the emirate level government to the extent of 51%, directly or indirectly, there is an exemption from meeting the tests and from reporting.
Yeah.
These entities still need to notify, but even if they earn income from a relevant activity, they do not need to meet the tests and report. So that's a government entity, 51% exemption. The second, which is not an exemption, but there is a criteria particularly for distribution and service centers. So if you're a service center business, and the definition of a service center business or a distribution service center business, let's pick that up. If you provide services to a foreign group company in connection with a business outside the UAE, then you're in scope of a service center business. So the media company example that you gave, if you are providing services to third-party clients who are not related to you, then you are not in scope. But if any of those services are provided to a related foreign company in connection with a foreign business of that related company, then you are in scope. Now, the only exemption or the threshold is that this business or this activity must be the main activity of the company.
Right.
So if it's not a main activity, but an ancillary activity or a one-off activity, and there is income that you get from that activity, then you are not in scope of the regulation. And there are some examples in the relevant activities guide that explains this. But the criteria for this to be a main activity is there only for the service center business, distribution and service center business. Otherwise, there's no threshold.
Now, what happens when the test is presented and the company has a large percentage of activity that does not relate to the main activity? What's going to be the feedback given by the authority? What are we expecting from that side of things?
So as I said, you only need to notify and report if you are, and report in particular, if you are carrying on a relevant activity and if you earn income from a relevant activity. So the report requirement, and while the format is yet not issued, but there is some information we have from the law, you need to provide details of your gross income from a relevant activity and expenses from a relevant activity. And the requirement to meet the tests and demonstrate that you meet the tests are only in respect of the relevant activity. So if a business does not carry out a relevant activity or has a large proportion of income from a non-relevant activity, so if it carries out relevant and non-relevant activity, then the report is only in respect of income and expenses from a relevant activity and not the others.
I see. Excellent.
But
we have a few questions. Yeah, go ahead.
Sorry, I was just going to, just to complete that, once you file the report, and maybe we can come on and talk about that, the authorities under the law have up to 6 years to go back and question the report that you filed and ask for any information that they may consider appropriate to substantiate the report that you would have filed.
How often is the reporting meant to be done?
It's an annual requirement. Both notification and reporting will be an annual requirement going forward. So it needs to form part of the company's compliance program, because this is here to stay. It will need to be filed on an annual basis.
I mean, I guess this next question relates to the size of any given company, but what would be an average time that it will take a service provider like us or any other companies like you and others to produce this kind of reporting?
I think it all depends on how many entities a business group has, because as I said, the reporting and the notification is an entity by entity requirement. So, you could have some businesses that have 3 or 4 branches or companies in the UAE. The assessment and the test needs to be met for each entity and each branch. I would say the time is right. If you're looking at a June reporting, a June deadline for notification, I think businesses should start as soon as possible now to do the assessment of whether they carry on a relevant activity or not, and at least be in a shape to file the notification correctly by 30th of June. If the entities are within the scope of the relevant activities or perform relevant activities and earn income, the next stage would then be to see whether they meet the test or have met the test for 2019 and what governance program needs to be put for 2020 onwards to ensure that tests will be met going forward. And I think all of this, can be started in July. That second phase can start in July or August. With the report, which is only due in December, and we don't know the format yet. But given that this is a new regulation and given that this is an annual requirement, I suspect the first year there would be more time that would go into looking at the scope of the activities and what the business does. Next year onwards, unless there's a change in facts and circumstances, the entity classification should largely remain the same, and it should become more of a business as usual operation or a business as usual compliance. But the first year, there would be some time that would go. And we've already started helping and advising a number of clients that are in various phases of assessment as to whether they are in scope and are performing a relevant activity or not.
I see. We have a good question from one of the attendees. He's saying that he sees there's a few of the free zones that are not listed within your list of free zones that have provided information in regards to this resolution. We have a few clients for Shams, Fujairah. Have all the authorities provided regulation when it comes to this? You're muted.
Sorry. Yeah. Sorry, I was on mute. So unfortunately, not all authorities have come out with a regulation. I'm just going back to the relevant slide. So far, I think the question is absolutely valid. I think all the 40 plus free zones in the UAE do need to come out with their notification formats, due dates. If over the last 2 months, all of these free zones have gradually been coming out with their notification timelines and templates. We are aware that a number of other free zones are in the process of looking into the requirements. And they're in the process of issuing notification due dates and guidelines. So my suggestion would be that if you're in a free zone that's not listed here, do reach out to the free zone authorities, understand where they are in the process, what's likely to be the due date. Some free zones have been more proactive than others in holding awareness session for their members. Others have just sent out FAQs and circulars to all their members. Some have posted it on their website. Some have written individually to the members that are licensed within their free zones. So just keep your eyes and ears open, reach out to the free zone authorities and understand where they are on their timeline. But the expectation is that you might get short notice and at least be prepared for a 30th June deadline for notification.
Right. I have another question coming in. It's saying, how about offshore companies registered in the UAE who engage in the relevant activity like a holding company and how they are treated?
So the FAQs that the government Ministry of Finance has issued expressly clarifies that offshore companies are in scope of the regulations. Some of the offshore regimes, so obviously we are awaiting guidance from Jebel Ali free zone, but free zone authorities like ADGM and RAC ICC have clarified that if you're an offshore company, then you do need to meet the tests and the details of your registered agent may constitute adequate premises for the purposes of these tests. But if these offshore companies are purely holding companies, which means they just hold shares and earn income by way of dividends and capital gains from those holdings, they are in scope as a holding company, which is expressly included as a relevant activity under the regulations.
Excellent. Well, we were going to go through the next part of the presentation that talked about the forms and how this is presented. Shall we go into this a little bit, Nilesh?
Maybe we can, do we want to discuss some of the relevant activities and a flowchart? Maybe we can end with a flowchart, but I just thought it'd be useful. I mean, we can look at the notification form. As I said, the report, there are two compliances. One is the notification, and the second is the report. The report format has not yet been announced, but notification format, most free zone authorities have come up with fairly similar requirements. And you should certainly look at the notification requirement and the format that your relevant free zone authority issues. But largely, the format is fairly simple and straightforward. I think the key information besides the name, license number, etc., is there are 2-3 things. So if you look at the reportable period, you need to provide a start and an end date. So the regulations require that the application of the regulation is for financial years commencing on or after the 1st of January 2019.
Yeah.
So you may have financial year starting at any point on or after 1st of January 2019. So you need to provide a start and an end date so that the authorities know to what period the notification or the report would relate to. Mm-hmm. The next part, which is on the relevant activities, as you can see, there are boxes to tick one or more relevant activity that the licensee might undertake. Mm-hmm. And this is really where, before ticking this box, you really need to know whether your activities fall into any one or more of these categories. Mm-hmm. If you fall into any one of these categories and tick one or more boxes, the next section is, do you earn any income from that relevant activity? Because as I said, only carrying on of a relevant activity is not enough. You must earn income from that relevant activity in order to fall within the scope of reporting. If you only carry on an activity but do not earn income. So for example, a company provides headquarter support to its businesses across the region. So there is a chief executive officer, chief financial officer sitting in Dubai, chief treasury officer responsible for managing the region and entities in the region. It is providing, that entity in Dubai is providing a headquarter function for the group. So it is carrying on a relevant activity because it's coordinating group functions, coordinating group activities, incurring expenditures on behalf of the group, etc. But if it does not cross-charge that income or cross-charge the costs to the various businesses, then there is no income that arises from the activity. So that business in my example would only tick the headquarter business box. But when you say, does the licensee earn income from that activity? The answer would be no, because there's no cross-charge or earning of that income. So if that's the case, then there is no requirement for a report. And then the third box on the right, assuming you earn income, what the authorities really want to know is whether any of that income was subject to tax in a country outside the UAE. And really the objective of this is to understand that if a piece of income was subject to tax already outside the UAE, then there is less requirement or expectation that this activity would have been performed in the UAE with a view to avoiding taxes in the home jurisdiction of the entity. So they really want to understand, has the income escaped taxation everywhere? Because certainly in the UAE, there is no tax on that income. So the objective is to find out if their income was taxed in another jurisdiction, then there is less scrutiny on that income because it's already been subject to tax and there's no tax avoidance that the company is engaged in.
Now, Nilesh, I have a good question here to throw in the middle of this description that you're doing. It says how to determine the operating income for headquarter services.
So you referred to operating income. I don't think the guidance uses the word income. The law uses the word income, the guidance uses the word income, and it defines income to mean all gross income that arises from all services in the context of headquarter business and service center business. So anything that's, then there is no reference in the law to income being determined by reference to either an accounting standard or income as recorded in the books of accounts or financial statements of the company. And on the basis that these are gross income that's charged, so if it's a headquarter business, if there are cost recharges for a headquarter business, then those cost recharges, so you've incurred a cost of 100, which is both internal management time cost, salary cost, as well as any third-party costs that you may have incurred or procured for the group. If all of those costs are recharged or allocated amongst foreign group companies, then that 100 of recharge in the example would constitute income, even though there are 100 of expenses and there is no margin or profit that the business would have made. That's how you do it, because there's no reference to an accounting standard or books of accounts other than perhaps ADGM that has clarified in its circular that income needs to be looked at by reference to an accounting standard or books of accounts. But the law and the guidance refers to gross income.
Now, how about holding companies? Sorry, I have a question here. It just went down 1 second. I just lost it. I had it in front of me. But I think it was saying along the lines of holding companies are simply collecting dividends from operating companies. So they don't have any operating income themselves. They're just collecting dividends. How does the law apply to these type of holding companies?
So that's simple. Holding companies only will be categorized as holding companies only if they have income by way of dividends or capital gains. So to the extent they've earned income by way of dividends or capital gains, that is regarded as income for the purposes of the regulations. There is no, we don't need to look at, any other criteria. You need to look at what dividends would have been declared, what capital gains, or consideration from sale of shares that you would have earned. You could well have a capital loss if you've sold shares in a company at a loss and realized a capital loss. That still would be regarded, in my view, would be regarded as income by virtue arising from gains or disposal of shares in a company. And that's the amount that you need to include in the report. Right.
There's another really good question here. It says, will a flexi desk be sufficient for purposes of fulfilling ESR requirements?
So I think that's a great question. Again, I think you need to look at the relevant guidance from your free zone. Your free zone authority should include guidance on whether flexi desks constitute sufficient or adequate premises. Some free zones have made this announcement. I think the DIFC has, and I believe RAC ICC has also announced. So one or two free zones have already announced that flexi desks will be regarded as adequate physical premises for the purposes of the regulations. I think if you have a single member or a single employee company, so you need to in any case prove whether, and let's say you've got a single employee company and there's a $1 million dirhams of service fees that company earns from services provided to other group companies. you need to be able to prove that one employee was sufficient or adequate, as the regulations require, that one employee was adequate in order to perform that service business that generated income of 1 million dirhams. And if you're able to prove that, and if you're able to prove that that employee was adequately qualified to do his work, his or her work, then that one employee really doesn't need more than one desk to sit in. So you don't need a grand office with multiple desks if one employee is adequate. So in that situation, a flexi desk, you can comfortably self-assess or self-declare that that flexi desk is adequate. But again, look at your business and look at the guidance from the authorities to confirm this point. Most free zones are clarifying that flexi desks should constitute adequate premises.
Excellent. There's another good question here. It says, what if all your billing takes place via a group company based in another country? For example, we provide all supporting infrastructure for local UAE customers and take all of the associated costs out, but Singapore office does all of the billing and collects all of the revenue.
So if there is, so I think the first step to look at that is, does the entity in the UAE perform a relevant activity? That's the first step. So if I understood correctly, the entity performs activities or functions for the group, for related group companies. If that's the case, then it's in all probability, it's likely that this will be classified as a service center business and in scope of the regulations. The next question is, does it earn any income? Does that entity in the UAE earn income from a relevant activity? I think based on the example that you've just read out, Lorenzo, the answer seems to be no. The income is not earned by that entity from a relevant activity. It's earned by a group entity. And that should take you out of the scope for reporting purposes, although you will still need to or may still need to notify that you are carrying on a relevant activity.
Right.
Because the idea is that in Singapore, let's say, where the billing happens, Singapore has a full-fledged corporate tax system with corporate tax rates at around 17%. So in Singapore, that billing or those revenues would get taxed. And there is therefore no tax avoidance that that the structure seems to be creating.
Right. Excellent. Well, we have about another 10 minutes left on this conversation. To all attendees, we still have about 160 people connected, which is a great audience. Thank you everybody for connecting, and please keep on sending your questions out. Nilesh, what's next in your presentation? What else we can share with everybody today on this subject?
Well, I think if I can spend a few minutes just very quickly running through some examples of the more likely activities and see what people think. So in this example, you've got a group company in the UAE, the UAE Co, that purchases goods from an Indian company and resells these goods outside the UAE. Question is, would this be a distribution center activity? I think it's fairly straightforward. The answer is yes, because you've got the requirement to import, purchase and resell outside the UAE. The question that arises are these drop shipment models where the goods are directly shipped by a foreign related party, so Indian company in this example, directly to Middle East customers. So it's a direct flow of goods without touching the UAE. Would this be included under a distribution center model? I think there is, currently there's no clarity, or there's limited clarity on this. The law actually requires the goods to be physically imported into the UAE and stored in the UAE and then sold to Middle East or customers outside the UAE. But if you look at the relevant activities guide that's come out subsequent to that, there is, it seems to suggest that even drop shipment models would be included. And if you look at the real intent of these OECD and proposals, drop shipment models should be included in scope. So businesses should prepare to notify on drop shipment models as well. If you look at the second example on service centers, where there is a company in the UAE that has as its main activity provision of HR administrative support to its group company outside the UAE. And let's assume that the services are also recharged at cost. The UAE company will be considered as carrying on a distribution and service center business, even though there is no markup that the company charges on its activities. And this again will be a very common model in the UAE. I think this is an interesting example. This is in the context of a holding company. So the way the holding company, this will be a common situation where you've got a company in the UAE, ABC. It manufactures food products, does other activities, but also has a 100% holding in another UAE or a non-UAE company, and earns dividends from that business. Now, the way the regulation applies is, in this case, ABC Limited is not conducting a holding company business, even though it's earning dividend from its shareholding, because its only activity is not the holding, or predominant activity is not the holding of shares. It also carries out other commercial activities. So it's not that all companies that hold shares in other companies will be classified as a holding company. I think you need to, in order to fall within the definition, the primary objective of the company should be to hold shares, and the company must only earn income by virtue of dividends and capital gains for this to be in scope. Again, the audience should be mindful that not all holding activities will fall within a holding company business. You need to look at what else the company does and if any other commercial activity the company carries on. This is an interesting one. Again, a UAE company holds shares in 2 subsidiary companies. It has also provided an interest-bearing loan to one of these companies and earns interest from those loans, besides earning dividend and capital gains from its subsidiaries. As per the guidance, this company will not be considered as a holding company, but will instead be regarded as a lease finance company on the basis that it is providing an interest-bearing loan to subsidiary 1. So it falls out of holding company definition and falls into the lease finance definition. And this just shows how a structure that may seem clear as a holding business or as a particular category of business could get categorized as another relevant activity. And there are obviously, the tests have to be met in respect of that relevant activity.
We have a couple of good questions coming in the interim of this slide. It says, the relevant free zone license issuing authority has 6 years to go back and query, or is it the Central Assessment Office of the UAE? Who has that power of going back these 6 years?
As per the law, it's the relevant regulatory authority that has been delegated the powers by the Ministry of Finance to perform the audit and ask any relevant questions in relation to a report. And currently, it's the relevant regulatory authority or the free zone authority that is required to perform this audit 6 years, up to 6 years from the end of the relevant year. I mean, they might do it sooner than that, but they have up to 6 years to go back and check. It's the free zone authority.
So I guess this is where KPMG comes in, right? And is this where you are advising authorities on the structures and the procedures on how to go about this?
We are in discussions with a number of authorities to see how we can help them get ready as a regulator.
Right.
And what are the things that they need to, the structure and the operating protocols and the procedures that they need to put in place to be ready as a regulator. We've been in conversations with many of them.
All right. We have a good question from a client. I'm not sure if I'll be able to read it correctly because it's a little bit specially written, but it says, "Hi, Creative Zone is our holding company, having the main sponsor in our DED LLC license. Is there any consequence for them, I'm guessing, and we a lone company having only one partner visa in the company and no employee visa? Is there any consideration for me as an owner?" He's asking. So
I think if I understand the structure correctly, there is a company in the UAE which has, what does the company do?
Yeah.
So I think that's the first question. What does the company do? Is it a holding company or is it an operating company? So that's the first thing. So we need to first determine if there's a company, what does the company do? That's your first step.
Yeah.
Is the entity carrying on a relevant activity? Let's forget about the employees and the owners for a moment. What does the company do? If the company does one of those 9 activities, it's in scope. If it does not do one of the 9 activities, you don't need to go further, other than perhaps a notification. If it's doing one of those 9 activities, then really you need to meet the test, which means you need to demonstrate that you've got sufficient employees, expenses, premises. If you don't have an employee, but instead have a director or a manager managing that company, the guidance clarifies that that should be sufficient to meet the adequate employee criteria.
Right.
So again, there isn't a carte blanche answer on this. I think it's a case by case determination of whether that adequacy test of employees or other tests, in fact, are being met or will be met or not.
Right. There's another good question here. It says, if the UAE company buys from Indian company and sells to Europe without goods entering the UAE, will it be considered in scope, even though Indian company and European company are not related parties to the UAE company?
So this is the drop shipment model that I was explaining about. I think that the key thing to look at is whether if the Indian company and the UAE company is related, and if the UAE company is buying from an Indian company, even though goods do not physically come, it doesn't matter whether the Indian related company and the customers are related or not.
Right.
The key is whether the UAE company that buys from the Indian company, are these two related? If these two are related, it doesn't matter. And again, as we just discussed, drop shipment model where the goods physically do not enter the UAE are also potentially in scope. But the key is whether the purchase is from a related party. If the purchase is from a non-related party and sales are to non-related parties, then the activity is out of scope.
Right. Excellent. Sorry, I cut you off. You can continue with the slide that you were showing.
No problem. I think we've looked at most of the examples. I think just one aspect that we've not touched on, as I said, as far as the adequacy test is concerned, you need to demonstrate you've got adequate employees, adequate expenditure, and adequate assets in the UAE.
Yeah.
You are allowed to outsource. So you can outsource the key activity, the core income generating activity in relation to a relevant activity can be outsourced. However, you must be able to prove that you have adequate supervision of that outsourced activity, and that outsourced activity has to be conducted in the UAE. So for example, a company is performing, its main activity is to perform services to foreign group companies.
Yeah.
However, it does not itself perform those services, but it subcontracts the execution or the performance of those services to another service provider. In what the regulation says is that is fine, that the company does not itself perform the services. It has outsourced the performance of services to another service provider. However, this would be fine provided there is an agreement between the company and the outsourced service provider that shows that there is the UAE company has adequate supervision of the outsourced activity, and that outsourced activity is being performed in the UAE, and that the outsourced service provider has itself adequate assets, employees, expenditure, premises through which it performs the services. So again, if you look at the intent, as long as you're able to show that the key activities that are being performed in the UAE through adequate substance, whether yourself or through a service provider, an outsourced service provider, that would be fine. I think what they want to do is discourage you from setting up a company in the UAE that would provide services to foreign group companies, earn income from those services in the UAE, which are not subject to tax, but the effective performance of those services is outsourced to another company in another jurisdiction in which it would otherwise have got taxed. I think that's what they want to discourage.
Right.
To set up structures that are just parking income or profits in the UAE without appropriate substance, and there's no tax, and effectively resulting in that income not being taxed anywhere.
So what type of companies that are doing that kind of operation will this affect the most? would you say?
I think there are, I mean, it's be difficult to say what types of companies. I wouldn't want to presume that there are companies doing this, but I think you need to look at all types of companies. I think you can outsource back office functions outside the UAE. It's common. Many businesses in the UAE have their outsourcing centers, back office centers in India, in Jordan, in Egypt. As long as back office services or back office functions are outsourced, that's fine.
Right.
It's your front or your core income generating activities that must not be outsourced. A typical model is, you've got 3PL licensees and logistics service providers. So where importers use 3PL service providers for storing the goods that come into the UAE. There must be an appropriate agreement between the company, that's the importer, and the 3PL logistics service provider. And it's important that the 3PL logistics service provider is in the UAE and has appropriate substance, as opposed to having its operations or facilities outside the UAE, and there's only revenue or income being booked in the UAE.
Excellent. Well, we are reaching the end of this presentation, Nilesh. We only have 2 more minutes left.
I think.
Yeah, go ahead.
Yeah, I think what I've just tried to give, I'll conclude with this slide and then happy to take any final question. I think in order to give some direction to the audience in terms of what needs to be done by when, I've tried to, give this some shape with some timelines. So your initial assessment as to whether your entities are in scope or not, and the notifications that need to be done should be done by 30th of June. Thereafter, for all the in-scope entities that do carry on a relevant activity and earn income from there must be a gap analysis that you need to do to determine what is your current level of substance in the UAE versus what's required under the regulations, and what are the remedial actions that you need to take in place or to fix any remedies for 2019, just in terms of documentation, or arrangements that you need to put in place, a governance framework that you need to put in place for 2020 onwards, so that on a going forward basis, you're in a better position to meet the test. So that gap analysis can be done from July onwards, and then really in December is when you need to file the report. So there'll be a host of information that you need to pull out from your financials and other records to make an accurate reporting in December. So again, these are just broad pillars of work streams that businesses need to do, and indicative timelines.
Excellent. Well, we're having a question here that was saying, are we able to get access to this presentation? Yes, we will take this copy and we will send it to everybody that has attended today, over 180 people. So we are happy to send this out. Us as a company, Creative Zone, we have a whole division called Tax and Accounting that is happy to deal with all your queries. And as well, Nilesh, we can provide his details, his email addresses are showing there in the presentation. So we are happy for you to connect directly with him as well and ask him any questions, anything that you would like to learn more. Nilesh will be sharing this presentation with the audience if you're happy with that, yeah?
Sure, Lorenzo, we can pick that after the webinar and arrange to get that done.
Yeah, excellent. Well, if we don't have any other questions, any final thoughts, any final comment that you can put through, Nilesh?
Yeah, I think I'd just like to conclude by saying, many clients have, when we've been talking about the ESR regulations, many clients have asked me, are the authorities really going to implement it? Are they really going to enforce this regulation? Because it seems to have come out of the OECD pressure and the EU blacklist that UAE was put under. The only thing I can say is that, as you've seen, the authorities have come out with a number of guidance following the original legislation. Free zone authorities have come out with notification deadlines. Importantly, at the OECD level, UAE has committed to the OECD and has agreed to participate in its inclusive framework program. What really that means is that OECD will now monitor UAE's implementation of these regulations, both at the legislative level and also at the practical enforcement level. And they will be reviewing UAE's compliance with these regulations. So UAE will have no choice but to implement these regulations in letter and in spirit. And all I would urge to say, because there are penalties associated with non-compliance, we didn't touch on that, Lorenzo, but there are financial penalties associated with non-compliance, and there's also possible striking off of licenses for continued non-compliance of these regulations. So do take these regulations seriously. Do prepare for complying with these regulations, and have a program in place such that you do not comply with it just on a one-time basis, but on an annual business as usual basis. You are prepared to deal with these regulations. It's no different to VAT, where you've had returns that you need to file on a regular basis and have a compliance program. This is another compliance program that you need to include in your areas of work that needs to be done.
Right. Yeah, that's a good point, actually. We wanted to address this issue of the penalties. And aside of this, are there any government fees that relate to this?
No, so there are penalties. If you fail the test in the first year, there's a penalty of between 10 and 50,000 dirhams. If there's a continued failure in the second year, there's a penalty that goes up to 300,000 dirhams. And then there are other penalties. If you fail to respond to the authorities with any requests, penalties can again range between 10 and 50,000 dirhams. So there are penalties. And then if you continue to fail the test, then the Ministry of Finance will exchange your report, or exchange the fact that you failed the test. They will exchange that with the authorities tax authorities of countries where the ultimate beneficial owner or where the parent company is located. So if you're a company in the UAE that's a subsidiary of the UK parent, and if you fail the test, then the Ministry of Finance in the UAE will share the fact that you failed the test with the HMRC, which is the tax authority in the UK, and they will then have the ability to deal with the parent company in the UK to ensure that there's no tax avoidance or tax evasion measures being implemented. So the consequences can be quite severe.
Excellent. Okay, Nilesh, thank you so much for taking the time to do this webinar with us. We would like to thank all the attendees, 170 people connected. We will share notes. We will share a summary of this webinar. We will share the presentation, and we're happy to take this conversation offline through getting in touch with us through email, through phone, and to expand more on this. But Nilesh, again, thank you so much for your time, and we look forward to keep on collaborating with you and at KPMG as we've been doing it over the last few months.
Great. Thank you very much, Lorenzo, for the invitation and the opportunity to speak, and for the audience for patiently listening to my webinar and for your questions as well. Thanks very much.